Okay, we're going to talk about the adjustment process specifically as it relates to deferral adjustments. So before starting this clip, I hope you have watched the Part A that gives you the background of it on the adjustment process. This is just a continuation of that clip. But looking back at the end of the period, we're going to be closing the books, and I'm sure you've all heard that term, close the books. And what we want to make sure is that we have included everything that we needed to include from the prior year on our financial statements, and that we're not including anything that belongs in the next year on our financial statements. So if we take a deposit for revenue to be earned in the future, we have collected deferred revenue, and it's sitting out there in a liability account because now we owe our customer. Yes, when we've taken money in advance from a customer and we haven't performed the service or delivered the product, it's a liability to us. Or we may pay an expense in advance before we've used it up or consume the product, and that's a deferred expense. So deferred expenses are classified as assets until we use them up. Both of these types of accounts need to be adjusted at the end of the accounting period due to this very basic accounting concept called the matching concept. Have we matched it with the year that it belongs in? So there's basically two types of deferral adjustments. We have deferred expenses, and those are expenses that we've paid for in advance, and when we come to the end of the period, we have to decide, does some of that, because when we record in advance, it's sitting out there in an asset account, do we need to record some of that as an expense in this period? So when we do that, we're going to be increasing some type of expense account because we're going to take it out of our prepaid account, which is an asset, and we're going to transfer it into an expense account. Our expense will be increasing, so we'll be debiting an expense account, and our prepaid account will be decreasing. Prepaid accounts are an asset, so when they're decreasing, they're recorded as a credit. And then the other type of deferral adjustment is deferred revenue. This would be when we've collected revenue in advance, before we've earned it, and we come up to the end of the period and we have to decide, well, did we really earn any of that in the period? If we're able to determine that we've earned some of that in the period, we're going to be debiting our unearned revenue account because unearned revenue is a liability. So as we earn it, we take it out of that liability. We're decreasing the liability account. Decreases in liabilities are recorded by debits. And we'll be crediting whatever type of revenue account that is involved. So when you're reading about deferral adjustments, if you can just remember, there's only two types. There's either a deferred expense, when we're going to debit an expense account and credit a prepaid account. And you just have to determine what type of expense and what type of prepaid account. Or we have deferred revenues where we're going to debit some type of unearned revenue account and credit some type of revenue account. And you just have to pick what kind of account that is. So looking at our problems to work, and I hope you have downloaded these as you are looking through this video clip. The first one here, I think the best way to handle this is just to read through and try to do some problems. The first one says here, in the balance of the unearned fees account before adjustment at the end of the year is $32,000. But after a careful review, we realized that the amount should be $21,000. So the first question here is, what is the amount needed to reflect the $21,000 current balance in unearned fees? Okay, so what's sitting out there now on your books, because you haven't done any adjustments, is $32,000. But we realize that the balance needs to be $21,000. So in order to determine what the adjustment is, I'm going to have to subtract the $32,000 from the $21,000. So I'm going to go ahead and put that up here. The amount needed would be the $32,000 minus the $21,000, which is going to give me $11,000. And if you can't read that very well, I'm sorry, I'm kind of running out of space here. What kind of adjustment is this? Is it a deferred revenue or a deferred expense? Well, if we go back and read it, it's talking about unearned fees. So unearned fees is relates to fees, which is a revenue. So it's deferred revenue. All right, so if it's a deferred revenue, that with that $11,000, we're going to be debiting some type of unearned revenue account. In this case, it's going to be unearned fees. And we're going to credit a revenue account. What's the revenue account that goes with unearned fees? It would be fees earned. Okay, and the second problem given here, on your handout it says the prepaid insurance account had a balance of $19,000 at the beginning of the year. The account was increased by $6,000 for premiums paid on policies during the year. It says determine the adjustment required at the end of the year for each of the following independent situations. Okay, we're determining the adjustment required. So some type of adjustment is required. All right, so the first question on your handout asks, what is the amount needed to adjust the account to reflect the current balance in prepaid insurance? Okay, so first of all, we have to figure out what's sitting out there already and then what our adjustment needs to be. Well, it tells us at the beginning of the year we had $19,000, but we increased our account by $6,000 for the premiums paid on policies during the year. So we're going to add together that $19,000 plus the $6,000, which gives us $25,000. But now Part A tells us the amount of unexpired insurance premiums applicable to future periods is $8,000. So what this is really saying is that's how much we need to have in our account. We have $25,000, but we should have $8,000. So we're going to take that $25,000 and subtract the $8,000. And that is going to give us $17,000. So our adjustment needs to be for $17,000. Again, the balance we were trying to achieve was $8,000, but we had to subtract it from the $25,000 that was already there. All right, so our adjustment will be for $17,000. Is this a deferred revenue or a deferred expense? Well, if you go back and read it, it's talking about prepaid insurance. The only time insurance is going to be a revenue is going to be if you're an insurance company. So prepaid insurance should be a deferred expense because we paid our insurance in advance. That's actually a very common deferred expense because most insurance we pay in advance, sometimes many months in advance. So if it's a deferred expense, we're going to debit some type of expense account. All right, we already determined it was $17,000. What type of expense account goes with prepaid insurance? Well, I believe it would be insurance expense. So we need to debit insurance expense here for $17,000. Then it says we're going to credit a prepaid account. What prepaid account goes with this problem? Well, it starts out telling us about the prepaid insurance account. So we must be going to credit prepaid insurance. Again, we're using up the prepaid insurance. We first recorded as an asset, so it was out there as a debit. And now we're decreasing that asset, so we're going to be crediting prepaid insurance for $17,000. One thing to remember when you're calculating deferral adjustments, especially when it's result when we're looking at expenses and trying to determine them is that you're always trying to determine figure out what's expired or what's used up. So in this problem, it told us at the very beginning in Part A what was unexpired. When it tells us what is unexpired, we have to subtract to get what's expired. But in Part B of this problem, it tells us the amount of the insurance expired during the year is $17,000. How would this change the amount of the adjustment needed to reflect the current balance in unearned fees? Well, if it tells you what's expired, that's the number that you need to do the adjustment for. So what they're really trying to do with this particular problem is to trick you, because you've already figured out the adjustment needed to be $17,000 in Part A. The question now is asking you, how would this change? It would not change at all, because it's telling you what's expired. What expired was $17,000, so your journal entry would be the same. So it's important when you're reading through problems, are they giving you what's expired, and you can use that number exactly, or are they telling you what's unexpired, in which case you would subtract from the current balance to figure out the amount that you need to adjust for. And we will be covering accrual adjustments in the next segment.